In 5 years of investing, I've learned the hard way what works and what doesn't. In this first video of the series, you'll learn how to calculate 2 key valuations for any stock. And I will show you 2 warning signs that should instantly raise a red flag. I'm splitting this into a series because once I started recording, it became clear. Squeezing all of this into one long video would be overwhelming. So we are doing short, focused episodes so you get high quality insights without missing anything. Let's get started. For this, we are using Google Sheets. I've started this table a little bit further down the page because we are going to place a graph above it later. That's why we are starting around row 21. In this table, we track a few key metrics, such as revenue, gross profit, net income, EBITDA, cash flow from operations, and so on. Up here in the cell C19, we have a ticker symbol, so we always know which stock we are analyzing. For this example, we'll be using Nike, just so we have our real numbers to work with. Now the data I'm using in this example comes from macro trends, but you can pull this information from any site. The reason I've built a second table off to the right, starting in column AW, is because of how macro trends formats its data. By copying the raw data over there first, we can keep the main table clean and organized. You will also notice I leave 2 empty columns between each data point. That's intentional, because the year is baked into the data when we copy over from macro trends, and also not all data is used in the main table. What we collect for this table are revenue, gross profit, net income, EBITDA, EBIT, capex, debt, cash flow from operations, dividends, and shares outstanding. In the last column, we have our first formula. We use debt-to-EBITDA, which is simply debt divided by EBITDA. Now let's jump over to macro trends and grab the data. We'll start with revenue, and then repeat the same exact process for other metrics. As you do this, make sure the years line up. Once everything is aligned and looks okay, we can return to our main table to work on it further. Now that we have all the raw data, the next step is simply linking them from the helper table into our main table. Also, don't forget to link the years, as you don't want to have a mismatch. For formatting, I like to treat everything as a plain numbers instead of dollars. Adding currency symbols just makes the sheet feel cluttered and harder to read. Once all is linked, we can start calculating. Starting with revenue, we calculate year-over-year change so we can see how fast the company is growing each year. To do that, we simply divide our 2025 revenue numbers with 2024 numbers and subtract 1. To make this even easier to read at a glance, we can add in conditional formatting. We can use greater than format with 0% as our number and green for formatting style. Then we can simply click on add another rule and change formatting to less than 0% and change the format color to red to show all the negative growth. Looking at Nike as an example, we can see only 2 negative revenue years, one in 2020 and another one in the most recent year. Everything else shows consistent growth. Next, we can start calculating margins. For gross margin, we divide gross profit by total revenue. For revenue, we put the dollar sign in front of the B, so we can drag and copy the formula to other cells. We copy this formula all the way to the free cash flow. To make the result stand out, we'll use conditional formatting again, but this time we'll use a color scale. The setup is simple. For the minimum value, we change it to red, green for the maximum value is left untouched, and for midpoint we use a percentile, while white as a formatting. Now it's immediately obvious which years were strong and which were weak. We repeat the same process with a color scale for all the margins. Now for the free cash flow. We have to calculate it by adding cash flow from operations and capex. Just be careful here. Capex needs to be a negative number. If your data shows capex as positive, you'll need to subtract it instead. If everything is correct, the scale from conditional formatting we set up earlier should work just fine. Next up is shares outstanding. Here we calculate the year-over-year change just like we did with revenue, but the conditional formatting is flipped. A decrease in shares is good here, so that's green, and an increase is red. For Nike, you can see that shares increased in only 2 years, while most years show a steady buybacks. Then we move on to dividends. First, we calculate the dividends growth year over year, using the same formula as shares outstanding and the same conditional formatting. After that, we calculate the dividends payout ratio by dividing dividends paid by the net income. Since dividends are listed as a negative number here, we add a negative sign in front of the formula. If your data already shows dividends as positive, you can skip this step. Finally, we calculate dividends per share by dividing dividends paid by shares outstanding, and with that we completed the core structure of the spreadsheet. Now let's move on to data analysis part, starting with CAGR, or compound annual growth rate. This tells us how much on average a company revenue has grown each year over a given period. We'll start with revenue. The formula is simple. In a brackets we divide the most recent revenue by the oldest one, then raise it to the power, we add brackets again, add 1 divided by the bracket again, last year, in our case 2025, subtracted from the oldest data point, in our case 2011, we add the closing brackets, followed by subtracting 1. Here, be careful that both year data in column A have a dollar sign, so the formula doesn't shift when we copy it across. Next, we add some basic statistics to give us more context. We add median, low, high, and average. These are all straightforward formulas, for all data ranging from row 22 to 36. For the median formula is used. For low, a mean formula is used. For high, a max formula is used, and for the average, an average formula is used. Then we can copy this entire setup across to other metrics. For CAGR, I also like to add an extra column that looks at a shorter time frame. For example, we can calculate CAGR for just the last 5 years. This gives us another data point and often can tell a very different story. With Nike, you can see that from 2011 onwards, revenue grew at 6% per year. But from 2021 to today, growth has slowed to roughly 1%. That contrast alone already paints a very different picture. To make this section easier on the eyes, let's slightly shade the background in gray. Now let's move on to one of the more important checks in this spreadsheet, and one that can sometimes reveal misleading accounting. Here we are comparing cash flow from operations to EBITDA. To do that, we simply divide cash flow from operations by EBITDA, which gives us a percentage showing how much of EBITDA turns into cash flow from operations. We calculate this year by year, and then we also calculate an overall average by summing all operating cash flow and dividing that by the sum of all EBITDA. For Nike, it is at 81%. Earlier I mentioned adding a chart, and this is where that comes in. We create a scattered plot using EBITDA, cash from operations, and the year column. Then we add a trend line that lets us see whether both metrics are growing together and if at roughly the same pace. In Nike's case, cash flow from operations is increasing in the same direction and at a similar rate as EBITDA, which is exactly what we want to see. If, however, you see EBITDA constantly growing faster than cash flow from operations, that's a red flag. It can mean that the business looks more profitable on paper than it is in reality, and valuation multiples may appear cheaper than they truly are. And that can easily lead to disappointing stock returns. But let's move on. Before we continue, we need a few additional data points: shares outstanding, total debt, total cash and short-term investments, the perpetual growth rate, and our discount rate. Shares outstanding we already have, so we can just link that over from the previous table. For total debt, I will use another free tool called Ticker Terminal. I simply open Nike's balance sheet, scroll down and grab total debt, which is just over $11 billion. From the same balance sheet, we can also put cash and short-term investments. In Nike's case, that comes out to about $9.1 billion. We can enter both of those directly into our table. Next up is perpetual growth rate. This represents how much we assume the company grows forever. I usually keep this conservative around 2.5%, roughly in line with long-term economic growth. And lastly, the discount rate is the return we seek. For this example, we'll use 10%, which is roughly in line with long-term S&P 500 returns. If you want a bigger margin of safety, you should absolutely use a higher number here. Now we can move on to our first valuation method. For this, we need a few more inputs: net income, depreciation and amortization, and deferred income taxes. We already have net income, so we can link it from our table above. To get depreciation, we'll go to our very first table on the right. Here we will calculate it by subtracting EBIT from EBITDA. For deferred income taxes, we'll pull it directly from the company's filings. To do that, we go to SEC filings and search for Nike's latest 10K. Open it and scroll down to the consolidated statements of cash flows. There we can find deferred income taxes. Let's copy the values for the most recent years, and for older years we should repeat the same process with an earlier filings. And don't worry, I will link all the websites used in the description below, so you don't have to search for them. If you enjoyed the video so far, a like and a sub would mean a lot. Thank you. Now we need to sum everything together to complete this section. Below that, we create another small table for CAPEX and common and preferred dividends. CAPEX we already have from earlier, and we can link it in. Now, macro trends doesn't break out preferred dividends, but in Nike's case, they aren't any. So common dividends are all we need. For other companies, you may need to double check this using a different data source, and we again sum all of this together. Now we have all to calculate residual cash flow from primary business. This tells us how much cash the business actually generates. To calculate it, we simply add the sums of our two tables for each year. In the Nike's case, that leaves us with about $1 billion in residual cash for the last year. Nike shows positive residual cash every year, which is a very good sign. This metric can also expose problematic companies. In the past, businesses that paid large dividends despite weak cash generation show negative residual cash, a major red flag that then also led to bankruptcy of Enron in 2001. If residual cash is constantly negative, you need to be very careful. Next, we can calculate free cash flow. This one will be a little bit different from the one in the main table above, and for this one we take our first sum and add in CAPEX. For 2025, that gives us roughly $3.3 billion in free cash flow. From here, we can also calculate the dividends coverage ratio for all of you who love dividends. To do that, we divide free cash flow by dividends paid. Since dividends are negative in our data, we add a negative sign in front of them so the ratio comes out positive. As a rule of thumb, a ratio above 1.5 means the dividend is safe. Below 1 means it's no longer fully supported by business and can mean dividends are debt funded. In the long run, this can lead to dividends cuts. Nike comes in at roughly 1.4 for the most recent year. Not dangerous, but definitely something to watch closely. Now let's estimate what the company might be worth. To do that, we average residual cash from the primary business, multiplied by 20 and divided by the most recent shares outstanding. That gives us an estimated value of $33.80. We do the same using free cash flow, which gives us a higher estimate at around $59 per share. To refine this further, we adjust for debt and cash by subtracting debt divided by shares outstanding and adding cash divided by shares outstanding. Since Nike has slightly more debt than cash, the valuation comes down a bit. So what do these prices actually mean? The residual cash valuation shows what the business is worth after all expenses and dividends. Essentially, what's left for the owner. It is more of a guideline what the core business is worth. The free cash flow valuation, on the other hand, includes dividends that you will get, which is why it results in a higher value. We'll stop here for this video, and in the next one we'll move into future projections and valuation assumptions. If you are interested to learn more, watch this video next. If you have any questions, feel free to ask them below. And I'll see you in another video.